Most people know that the Federal Reserve controls interest rates, but the central bank's role extends far beyond just setting borrowing costs in the U.S. In fact, the Fed is critical to maintaining a stable economic environment that benefits households, businesses, and long-term investors alike. However, what makes the Fed so effective as an institution is something that gets far less attention: its independence. But what does that mean, and why is it so vital for your portfolio? After several financial crises in the late 19th and early 20th centuries, the Federal Reserve was created by Congress in 1913 to help establish and stabilize the U.S. financial system. Crucially, it was established as an independent institution, meaning it was intentionally set up to operate outside of political influence. This independence ensures interest rate decisions are guided by economic data and expectations, not political agendas. This distinction is vital to its credibility because rate policy is broad, blunt, and slow-moving, shaping the entire economy rather than just specific areas. Importantly, when markets trust that the Fed's actions are focused on long-term economic stability, policy is more effective, markets are less volatile, and borrowing costs are lower. There are times when the Fed's independence has been called into question. In the 1970s, we actually saw what happens when that trust erodes. At that time, inflation was at record highs, and markets questioned whether the Fed would act decisively enough against rising prices amid political pressures. And ultimately, confidence in the Fed plummeted, and long-term yields rose sharply as a result. This increased borrowing costs throughout the economy. Eventually, the central bank's credibility was restored due to the strong corrective actions, but the lessons remain. If the market loses faith in the Fed, it becomes much harder to manage inflation expectations and keep borrowing costs low. After that crisis of confidence in the 1970s, Congress gave the Fed a dual mandate, clarifying that the institution's goals should be to promote stable prices and maximum employment. And those objectives have guided monetary policy decisions to this day. So why is this important? A key reason the US dollar and US Treasury bonds are trusted around the world is the independence of the Federal Reserve. This autonomy helps global investors feel confident that decisions are being made consistently and with a long-term focus on the Fed's dual mandate. Investors, from large foreign governments to individual savers, buy treasuries knowing the Fed is focused on sound economic management, not short-term political pressures. When the Fed is viewed as steady and reliable, it reinforces the perception that U.S. assets are safe, which in turn helps support demand for both the dollar and Treasury bonds. For investors, the bottom line is simple. An independent Fed makes it easier for the U.S. to borrow at lower costs. It supports a stable financial system, and it helps keep the dollar strong. If you have questions about present-day monetary policy and how that may affect your investment portfolio, reach out to your Ameriprise financial advisor. Thank you.